Disclaimer. This content is for educational purposes only and does not constitute financial advice. Always conduct your own research before making investment decisions. Growth stocks versus value stocks, which investment strategy is better? When it comes to investing in the stock market, one question comes up again and again. Should you invest in growth stocks or value stocks? Both strategies have created successful investors, but they work in very different ways. Some investors are looking for companies with explosive growth potential, while others prefer buying high-quality businesses at attractive prices. So, which approach is better? In this video, we'll explain the differences between growth and value stocks, their advantages and risks, and how to decide which strategy may fit your investment goals. What are growth stocks? Growth stocks are companies expected to increase their revenue and earnings faster than the overall market. Instead of paying large dividends, these businesses usually reinvest their profits to expand, develop new products, or enter new markets. Many growth companies operate in industries such as technology, artificial intelligence, cloud computing, healthcare, renewable energy. Investors buy growth stocks because they believe these companies will become much larger in the future. Examples often include companies like Nvidia, Amazon, Tesla, and Meta, although every investment should be evaluated individually. Advantages of growth stocks. Growth investing offers several potential benefits. First, these companies may generate significant capital appreciation over time. Second, many innovative businesses lead entire industries and can experience rapid expansion. Finally, if you invest in successful growth companies early, long-term returns can be substantial. However, higher potential returns usually come with higher risk. Risks of growth stocks. Growth stocks often trade at higher valuations because investors expect strong future performance. If a company fails to meet those expectations, its stock price can decline sharply. Growth companies may also be more sensitive to rising interest rates and changing market sentiment. As a result, they tend to experience greater price volatility than more established businesses. What are value stocks? Value stocks are companies that appear to trade below their estimated intrinsic value. These businesses are often profitable, financially stable, and well established. Instead of focusing on rapid expansion, value companies typically generate consistent earnings and cash flow. Many also pay regular dividends to shareholders. Examples are commonly found in sectors such as banking, consumer goods, energy, healthcare, industrial companies. Investors following a value strategy look for businesses that the market may be temporarily undervaluing. Advantages of value stocks. Value stocks often offer lower valuations and stronger financial stability. Many generate reliable profits and dividend income, making them attractive to long-term investors seeking consistency. Historically, value investing has also performed well during certain market cycles, particularly when investors prioritize stable earnings over rapid growth. Risks of value stocks. Not every stock that appears cheap is actually a good investment. Some companies trade at low prices because their businesses face real challenges. This is known as a value trap, a company that looks inexpensive but continues to decline due to weakening fundamentals. That's why investors should always analyze the business, not just the stock price. Growth versus value, which performs better? There is no universal winner. During periods of economic expansion and lower interest rates, growth stocks have often outperformed. During times of higher inflation, rising interest rates, or economic uncertainty, value stocks have sometimes delivered stronger performance. Market leadership changes over time. This is why many experienced investors choose to own both growth and value stocks instead of relying on a single strategy. Diversification can help reduce risk while allowing your portfolio to benefit from different market environments. Which strategy is right for you? If you're comfortable with higher volatility and have a long investment horizon, growth stocks may suit your goals. If you prefer stable businesses, dividend income, and potentially lower risk, value stocks may be more appropriate. Many investors combine both approaches, creating a balanced portfolio that includes companies with strong growth potential alongside established businesses with solid fundamentals. The right strategy ultimately depends on your financial goals, time horizon, and tolerance for risk. Final thoughts. Growth investing and value investing aren't competitors, they're simply different ways of identifying opportunities in the market. Rather than asking which strategy is better, consider how each one fits into your overall investment plan. Building a diversified portfolio that aligns with your goals is often more important than choosing one style over the other. Remember, successful investing isn't about following trends. It's about understanding what you own and staying invested for the long term. If you found this video helpful, don't forget to like, subscribe, and share it with someone who wants to become a smarter investor.